Hello everyone, welcome to our discussion of Chapter 6. We're looking at self-employed business income. This is reported on the Schedule C and then on to Schedule 1 and then from Schedule 1 to the 1040. So this is very common and something that most of taxpayers are going to look at some point, and certainly one of the more, you might say, difficult areas of tax law in terms of just because the wide variety of types of businesses that could happen under these scenarios. So let's jump in and see some general principles about when this occurs. So first of all, we want to talk about the idea of it being a business. And the definition for somebody to have an activity that is business is that it needs to be engaged in for profit. They need to intend to make money at the business, and they need to act that way. And if they do not, it could be considered a hobby. And if it is a hobby, then the income, anything you generate from it, may be still taxable because that's the rule. All income is taxable, but the expenses, that cost of that, if it is a hobby, would not be deductible at all, and it wouldn't even come under the this area of the tax law. It used to be that you could deduct some of the expenses as an itemized deduction, but that went away, and so now it's even more important that if you want any of the expenses to be deductible, it must be engaged in for profit so it can be considered to be a business. All right. This is all reported, as I said, on Schedule C. So just a little accounting review, direct gross receipts. Remember, most of these businesses will operate under the cash basis, but sales to customers, you may have work you do as an independent contractor, which means instead of as an employee, you have control over when and how you do this stuff for someone else. If that's the case, then you are probably going to be considered an independent contractor, and they're going to send you either a 1099 MISC or NEC, non-employee compensation, what NEC stands for, and that's a new form for 2020, to report that they paid you, and then the IRS is going to match that up and see that on your Schedule C you report that you received that. So that's the issue. If you're self-employed, you'll get some of those. Now, some people won't send them to you, so it's not all of them are going to send you a 1099. Only those that are really considered businesses, because they are going to set that up to do so, and if you're paid by an individual, they are not. So you have sales as shown on these documents, perhaps, and then you have cost of goods sold, and we taught you accrual basis accounting in all of our other accounting classes, but for the most part, tax accounting, we use the cash basis. But what you are not allowed to do is use that. You have to use at least the accrual method of accounting for inventory if that is a major part of your business. Meaning you can't just record inventory when you purchase it as an expense. You have to keep track of how much you have and only count as cost of goods sold the amount that the stuff you sold. And so that is a requirement even if you're a small business. If you're bigger business, over 25 million, you've got to use accrual-based accounting no matter what, and for all of your accounting. Now, typically, if you're forced to use the accrual basis for inventory, and you're tracking inventory and sales that way, you can still use cash basis for other expenses. I know that's a little confusing. It's called the hybrid method. And so, for instance, you could use accrual for inventory, cost of goods sold calculated based on what you sold, but then things like legal expenses or utilities or things like that, you don't have to worry about when you owe it. You just have to worry about when you pay it, and then you do that on the cash basis. And that's okay as long as you're under $25 million and you elect to use the hybrid method. You're going to have those elements of accrual and cash basis at the same time. So what do you get to deduct? Now, there is all kinds of things floating around. People try to get deducted as an expense. First and foremost, remember, it's got to look like you're trying to make a living or make money at this. Not a living necessarily, but you got to show that you're doing it in a professional way enough to make money. If you make money, then that's not really an issue. So that's only if your expenses exceed your income on a business, then you really have to worry about the IRS challenging whether that is really a business or not, especially if you do it year after year. But just in general, expenses must be ordinary, necessary, and reasonable, and you have to show documentation for that. So it is not a situation where every expense has to be listed somewhere in the tax law or it's not deductible. But what it does have to fit is those three, and you have to be able to prove that that is the case. That is how the courts and the IRS have treated it. So ordinary means that you'd see it in other businesses and it's normal, and it's not what we call capital. It's not a big item that needs to be depreciated. That's the other thing that tends to be challenged by the IRS if you have an expense. Necessary, they don't have to be essential. They can just be something that you would do to generate business and that sort of thing. And it can't be way out of ordinary in terms of amount. Okay, so that typically comes into play for something like travel expenses. Say you need to travel to see a customer. Okay, you might run into trouble if that was extravagant in that you rented a limousine for the entire trip rather than taking a much more reasonable form of transportation. So it was still necessary you went and everything, but they may challenge that on a reasonable standpoint. Little harder for the IRS to do that, but it has happened. Some things, though, have been said to be, you can't deduct this no matter what. Bribes, kickbacks, and other illegal payments. Now, it's interesting. From an illegal business standpoint, illegal income is taxable. Illegal expenses are not deductible. So if they can show, and it wouldn't be the first criminal who was actually caught for tax evasion versus what their actual criminal activity was, and they were able to prove that the problem with taxes more easily in some cases than some of the others. All right. Lobbying and political expenses, no go. Okay, so we've made that off limits. Anything you pay to lobby someone to get what you want politically, that is not a deductible expense for a business. And then fines and penalty payments. And this is a little bit more of an issue because here's the thing. You go visit a client, you park outside their business. Inadvertently, you park in a no parking zone or you park too long or something, you get a ticket. You pay that ticket, you say, hey, that was the cost of parking outside my my client, and because it's a fine, it is not deductible. So you're speeding on your way to visit a client, not deductible when you get a ticket and have to pay that. Those fines, those kind of penalties are not deductible according to the law. So one of the most interesting and valuable, as well as kind of confusing deductions, is depreciation. So this is us taking an asset, something bigger, not a normal expense that's got to be done every month, but something that we're going to do once and then use that asset for a long time. So the tax law allows us to take that cost over time as depreciation. And what has happened in the tax law, as Congress has seen this as a way of encouraging businesses to buy more stuff, hire more workers, and build their businesses if they will really ratchet up how much depreciation they can deduct. So in normal accounting terms, we take depreciation over a useful life. We do it using a straight line method and take a little bit of the cost each year or something like that. So Congress believes that if you allow a business to deduct the whole or a big chunk of the cost of an asset, they'll buy more of them. So they've put a lot of special depreciation rules that are much far beyond the typical depreciation calculations we're used to in a regular accounting class. So we kind of have to think about it in new terms. First term that we need to make sure we understand is basis. That's usually its cost. That's the amount that we're going to apply our depreciation rules to. All right? And then we have depreciation periods. Over how long a period should it be depreciated? We have depreciation conventions, and there's 3 of them that we need to know: half year, mid-quarter, and mid-month. And then we have our methods. Remember, we learned declining balance or straight line in our earlier accounting classes. Tax law says you basically are using the 200% double declining balance. That's what I mean, 200%. The 150% declining balance, which is not used nearly as much, so don't worry too much about that. Or straight line, which is used quite a bit still. All right, and then this depreciation becomes an expense on our Schedule C. And as we'll see when we look at rentals in a later chapter, on Schedule E, which is where rental activities get reported, separate from business activities. So, as we look at each of these pieces, basis is if we buy the asset, then our basis is our cost, including any cost necessary to get it ready to get used. For instance, the sales tax, shipping, that kind of thing. That's, if we just bought an asset the normal way, that's our basis, how much we paid for it. Okay? But sometimes we convert personal assets to business. Like we may have a personal car that we're now going to use in our business. We may have a personal computer that we're going to operate in our home office as in a business. So when we convert that, our basis is not, we can't just look at what we paid for it. All right, we have to also look at the fair market value. So that computer you bought for $1,000 4 years ago, and now you're going to use it as business, you cannot use that $1,000. You have to use the fair value of it when you convert it to, and if it's 4 years old, it's certainly not what you originally paid for it. So instead of using $1,000, you may have to use a couple $100 as the basis, because that's what it's actually worth when you start using it in a business. You don't do depreciation until you use something either in a business or rental activity. If you're using a personal asset, you're not calculating depreciation. You're not taking that as an expense. So the depreciation is going to start when you start using it in the business, and you need to know what that basis is when you start using it as a business asset. Now, if it was a non-taxable exchange, and we'll get into what those are later, the basis is going to be the cost minus any deferred gain. All right, so it may be different than what you actually paid for it in that situation. And then just to make sure we have another, if you inherit something that you're going to use in business, the basis is the fair value at the date of death of whoever you're inheriting it from. So grandpa passes away and leaves you an asset that you're going to use in your business. It's basis that you're going to use to calculate depreciation is its fair value at the date of death, not what he paid for it. So in an effort to make your life simpler, the IRS has basically said you don't really get to choose the useful life of the assets. We're going to basically tell you what the useful life is, okay? And so almost all of our assets fall into these 5 depreciation periods. There's also a 10 and 15 years, which has a couple of things that come up, but typically this covers almost everything. Notice there's a difference between real property, buildings, that sort of thing, that is residential versus non-residential. Commercial building is 39 years. A apartment where people live is 27 and a half years. So you've figured out the assets, you know its basis, you know how long you have to use because the IRS hasn't given you, you still have a list, but you choose from that list, and then you got to apply a convention. Most of the time, the half-year convention applies. Mid-quarter applies when you buy too many assets at the end of a particular year, towards the end. And then mid-month convention applies to all assets 27 and a half years or 39 years. So any real property goes to the mid-month convention. And this applies in the year that you buy the asset and at the end of the year you dispose of it. What this means is half-year convention simply means that we're going to take a half a year of depreciation in the year we buy it, regardless of when we buy it, and a half year in the year we sell it. Mid-quarter means that we're going to treat everything bought in a quarter as if it was bought in the middle point of that quarter. So January through March quarter, we're going to treat as bought on February 15th. That's how we're going to calculate the depreciation, is as if February 15th. The whole point of these is it makes our life a little simpler in that we don't have to know the exact date that assets are purchased. Except, well, mid-month does a little better, but mid-month applying to all of the apartments, all of the commercial real estate, is treated as if it was purchased in the middle of a month. So anything bought between January 1st and January 31st is treated as depreciating from January 15th. From February 1st to February 28th, bought in the middle of February. Okay? Every month is treated the same. Anything bought in June is treated as if it was depreciated from June 15th on. So in the first year you buy any type of real estate, you're going to get kind of an oddball half a month calculation. And then you're going to be in straight line for other 27 years, and then the last year that you have the asset, okay, you're going to have this other half a month at the end.